Next, let me turn to other revenue options. I think several members touched on this. They asked if we can do more on other revenue options, especially income and wealth taxes. And in particular, the WP offered a range of revenue options as alternatives to the GST increase. The short answer is we cannot just ignore consumption taxes and put the entire burden on income and wealth taxes. We need a good mix of all three types of taxes: income-based, asset-based, and consumption-based. This is how we ensure that our revenue base remains diversified and resilient while achieving its objectives of being fair and progressive. In fact, all jurisdictions rely on these three forms of taxation, and the OECD jurisdictions have much higher VAT rates on our GST than Singapore. Much higher, all in double digits. But let me go through the revenue options one by one. Let me touch first on corporate income taxes, or CIT. As I said in the budget speech, it is hard to be definitive at this juncture about the overall tax revenue impact from both Pillars 1 and Pillars 1 and 2 of BEPS 2.0. International discussions are still ongoing on the reallocation formula for Pillar 1. Before we have reached an agreement, Mr. Louis Chua has already concluded that the impact of Pillar 1 will be limited because it only covers 100 multinational enterprise or MNE groups. Well, I think that's premature. I must clarify that though the number of in-scope MNEs affected is small, these are the largest and most profitable MNEs. Any reallocation of profits away from Singapore will have a significant revenue impact. And Mr. Chua then projected that the CIT revenue could be as high as $71.5 billion. $71.5 billion. Mr. Chua should have paused at this huge number for a reality check. He says it is purely hypothetical, but he should have said it is wishful thinking. $71.5 billion. That is the total amount of revenues we collect from all taxes. Does Mr. Chua really believe that CIT revenue from the profitable non-SMEs, the larger companies, will jump by 7 times from $10 billion to $70 billion? Really? Will the implementation of the minimum effective tax rate, or METR, bring us more tax revenue? Yes, the short answer is yes. Mathematically, it has to be so if nothing else changes. In other words, if we have the same volume of investments and business activities in Singapore, even as taxes go up with the METR, yes, we will collect more. But that is a very big if. It is hard to estimate with any confidence whether or how much net tax revenue we can collect from both Pillars 1 and 2. The eventual impact cannot be ascertained by a simple static analysis. And it will also depend on how governments and companies will respond post-BEPS 2.0. BEPS 2.0 represents a fundamental change in the competitive environment for Singapore. Hitherto, smaller economies like us could rely on tax incentives, not just non-tax factors, to make up for our inherent disadvantages like limited land and labor force. But this is no longer as effective post-BEPS 2.0. Companies will review their existing and new investments. Governments will also seek to compete via non-tax investment promotion in order to recover from the pandemic and to make up for what they can no longer do through tax incentives. Our engagement with investors is already revealing this. So likewise, Singapore will need to find other ways to stay competitive, from investing even more in our workers to building new infrastructure and incentivizing R&D. All these will mean more government spending. So even if we can generate additional revenue from Pillars 1 and 2, these will have to be reinvested towards ensuring Singapore remains competitive and attracts our fair share of investments to create good jobs for our people. I would therefore caution against jumping to conclusions or believing wild guesses on how much more revenue we can get from changes in global tax rules and use that as a reason to avoid raising the GST. Next, personal income tax, or PIT. Currently, the top 10% of taxpayers who pay PIT already account for about 80% of our total PIT revenue. With the top marginal personal income tax rate at 24%, we will be higher than the 17% top rate of Hong Kong and closer to the Asian average top marginal personal income tax rate of 28%. There is a limit to how much we can increase PIT rates for the top income brackets without touching the PIT rates for the income brackets below it. If we were to keep GST at 7% and raise the same amount of revenue through PIT, the top marginal rate would have to go up from 22% to 42%. And that would apply to everyone with chargeable income of $320,000 or more. And that is assuming the tax base remains unchanged. But we all know this sharp increase is untenable and will badly damage our competitiveness. Investments and jobs for everyone, including lower and middle income earners, will be impacted, not just taxes. So to raise the same amount as a GST increase through higher PIT, in reality, we would have to raise the PIT rates for a broader group of income earners, including the middle and upper middle income earners. And that was what Dr. Tan See Leng was trying to explain yesterday. In fact, Professor Hoon had correctly observed that as our economy matures and population ages, a bigger share of the population will become economically inactive. This will in turn shrink the tax base for income-based taxation. So we cannot rely only on income-based taxes alone if we want to maintain a resilient and future-proof revenue base. So I've covered corporate and personal income taxes. Next, wealth taxes. Mr. Louis Chua said we should do more on this front, especially on property taxes. On the other hand, several members like Mr. Chong Ki-Hiong raised concerns that increased property taxes will impact many retirees and senior owners of private residential properties. So again, we have to find a balance. In fact, the changes we've made to property taxes this time around are not insignificant at all, but we have structured it in a highly progressive manner. Together, our property tax moves raised $380 million more per year from a base of only 7% of all owner-occupied residential properties and all non-owner-occupied residential properties. For the owner-occupied residential properties, the increased tax rates affect only those with annual value above $30,000. That means all owner-occupied HDB flats are not affected. 2/3 of private residential properties, like condominiums in the suburban areas and lower value landed properties, are also not affected. The remaining 1/3 of private residential properties which are affected are higher-end condominiums as well as most landed properties. And then all non-owner-occupied residential properties will also face higher property taxes. The tax rates for these are higher because these properties include second homes and those held for investment. And the increases are also more significant for the higher-end non-owner-occupied residential properties. If we want to raise enough tax revenue from property tax to eliminate the need for a GST rate increase, what would we have to do? Well, we would have to tax all non-owner-occupied residential properties at a significantly higher rate. Let's say we tax all non-owner-occupied residential properties at a flat 36%. This would still not be enough because the number of non-owner-occupied residential properties is considerably less than that of owner-occupied residential properties.